Welcome to Asset TV's View from the Floor. I'm Gillian Kemmerer, and today we are joined by Dr. Satyam Panday, Chief U.S. Economist of S&P Global. He'll be talking about the indicators he's monitoring as a temperature check for the U.S. economy. Dr. Panday, it's great to have you here today.
Thanks for having me.
And I think we'll start with a look back before we look forward. So you obviously published a report in September and now another in January. How has your outlook for the U.S. economy changed?
So the report that we published, the business cycle barometer, that basically we have updated our recession probability for the year. We have lowered it now for the next 12 months to 25 to 30%. It used to be 30 to 35%, so that's good news. Just in general, the economic data that has been coming out in the past 6 months have shown more momentum in the growth. So that sort of has led to some of the downside risks to the economic growth to kind of dissipate, at least in the near term. But all in all, it seems like the resiliency in the US economy is holding up rather well, and at least through the first quarter of this year, we should see that still ongoing. It's going to be the second half of this year where things might start to get more interesting. But for now, it seems like we're in a resilient economy, a good place to be at.
We're obviously speaking on the eve of a Fed decision where mostly everyone expects that rates will remain unchanged. But do you think the market has outpaced the median FOMC member in their expectations?
You know, it is a bit of an open question right now. When is the Fed going to cut? How much is it going to cut? Where is it going to settle after it's done with cutting, right? And the market, it seems like they have kind of been taking each and every word from the Fed members with that, whether it's going to be more cuts or less cut. Every data point coming out has been, the market's been very sensitive. They right now have moved back, pared back a little bit in the first rate cut for May. We think it's not going to be before June. The Fed themselves, in their own summary of economic projections, they said that it would be most likely in June, or it's not really going before that. So I think the markets might be a little bit ahead of them. So just given the strength of the economy, although I have to say inflation has made quite a bit of progress. So that sort of leans more towards earlier cut. But still, what's the rush for the Fed as long as the economic cost is not so much, right? So,
one of the most interesting parts of your report is the discussion of the yield curve inversion. So I'd like to hear, in your view, what's driving that inversion, and do you think that it's a bellwether still, because it really is batting for 1,000 in terms of recession prediction?
Right. Yeah, you're right. In terms of recession prediction, the yield curve, the 10-year minus the 3-month Treasury, that normally tends to be the best indicator that we have so far. Not the stock market, but it's the yield curve, the 7 out of the last 7 recessions. This time around, though, I think we may be at a different moment, just because, when a yield curve inversion happens, it's generally the markets thinking that, the Fed may have to cut their short-term rates because we are in trouble. The economy is in trouble, a recession is coming. But this time around, the reason that the Fed will be cutting rates is different. It's because they feel like they've already raised rates much beyond their neutral, so-called longer run neutral. And so maybe it's time to now pare back some of that rate hike, just because disinflation has happened quite a bit. So maybe the market might be getting it for, or for the wrong reason. Or maybe it is for the right reason, but right now, at least the markets feel like short-term rates are coming down, and that's why the inversion of the yield curve may not specifically be showing recession in the coming 12 months.
So it may be losing its track record, so to speak.
This might be the first time. If you think about it, we've had historical moments, like back in 95 and 98, when the yield curve came very close to inverting, and folks were talking about how, hey, listen, this is going to be a recessionary year next, but it didn't happen. The Fed actually preempted it. They cut rates, and they sort of steadied the ship, so to speak, and we again sort of extended that expansion, right? So it may be that this time around we are having the same moment, that we will expand, we will extend the expansion, and that would be a good thing. It will be a more of a soft landing to the trend than anything else.
Be a really interesting metric to continue to watch. One of the things that has marred 2023 and early 2024, unfortunately, is geopolitical volatility. The markets have had a generally muted reaction so far to things that we've witnessed in Ukraine and Gaza, but could that change in the year ahead?
Like you said, it's been a muted reaction. So far, at least from what I understand, it's been contained. But geopolitical risks, they are contained until the day they're not, right? It can sort of sharply spike all of a sudden. Things could just get from bad to worse. We don't know that. So we do have to be mindful of that risk. Beyond that, at least for now, what I can see from what's going on in the Middle East is the spike in the shipping rates, the supply chain issues, that might sort of put a bumpiness to the disinflation curve that we are seeing right now. So maybe that will give a pause to the Fed. But again, it may more be a temporary pause than anything else. We are of the view that this inflation path should continue at least through the first half of the year.
So your report goes through a number of leading indicators, and it gives us a sort of mixed picture of what's ahead. So I'd love to go through perhaps each of your designations, which I believe were good, mixed, and bad. And if we start with good, what are some of the leading indicators that are pointing in the right direction?
I think you don't have to look too far. Just look at the initial claims of unemployment, right? These are the unemployment insurance claims that folks make when they are laid off. Very low numbers, even after adjusting for population growth. Same thing with the continuing claims. Yes, it has risen a bit, but not at the level that one should be very alarmed. We have new homes, the starts, the permits of new homes. They've found a floor and they've started to move back up. And especially with the mortgage rates starting to move back down, it may be that we are now in the cusp of the new home sales starting to pick up, starts construction starting to pick up again. Well, they have been doing well the last 6 months, but it looks like it's going to continue. So those are some good points. Consumer sentiment has bounced back. And then there are these indicators that are showing a bit of a mixed picture, right? Like the yield curve. You can think of the bank loans it's still in the tight territory. Financial conditions in general have loosened, but still, they do pose a bit of a headwind to growth. And then you've got the weaker ones, the weak leading, the bad indicators like in the manufacturing sector. It has been for a long time now, more than a year, that the ISM manufacturing orders index have been in the red, below 50. Not in the recession territory, but still not adding to growth. But all in all, we are at a place where the business cycle itself seems like it's in the late cycle period. We should be getting closer to trend rates than anything else.
To give our Asset TV viewers a little bit of homework coming off of this conversation, either among the indicators you've described or ones that we haven't talked about, is there any indicator that the market is not paying enough attention to right now?
In general, I think, given how the inflation debate has been going on, I think it's good to actually look at the trimmed median PCE. That's once you get rid of the most volatile, at the fringes, right? There are some items that tend to be very volatile in the inflation numbers. Once you get rid of those 15% at the top, 15% at the bottom, just a core median PCE, that would be a good signal of where inflation is headed. And I think we should have our debates sort of grounded with those kinds of statistically more pure indicators.
Well, Dr. Panday, thank you so much for taking the time to educate our viewers and to give us a sense of the data points you're keeping an eye on.
Sure. Thanks for having me.
And thank you for tuning in. From our studio at the New York Stock Exchange, I'm Gillian Kemmerer for Asset TV.